Hi, everyone. Thank you for joining me for this webinar. My name is Brad Renard, and I'm the Chief Publisher for Upside Options. And the objective of this presentation is to do a broad market update. We'll look at some of the indices, ETFs, and some stocks. I'll also give you some stock picks along with some economic data. Okay, I just want to make sure that if you could go into your question pane and just tell me if you can actually see my screen. Just let me know if someone can actually type in there and tell me if you can see your screen. Okay, excellent. I've got a couple. Thank you. All right, 1 second. Let me make sure. Okay, let's get started. So the questions I'm going to address in this presentation is, so the Qs and the NASDAQ Composite Index, they broke out to new all-time highs. So how is this influencing the rest of the market? S&P 500 index broke out above 3,025. So what's its next target and how is it influencing the market? If the market sells off again, how low can it go and where's it going to find support? What would be the best investment strategies for the balance of 2020? That is buying passive ETFs or stock picking or possibly trading, for example, like a non-directional options trading strategy. Should I sell some of my passive ETFs and stocks as this market trends higher? Should I add some short exposure to my portfolio? And then if we have some time, I'll talk about the Pinnacle strategy. Okay, now if anyone has any questions, I'm watching the question pane, so just let me know if you have any questions. Okay, so about me, I was in high tech for about 20 plus years. I'm an electrical engineer. I started in the space division at General Electric in New Jersey. Then I moved into a couple other different industries, mostly chip design software. I was in marketing and then sales, VP of sales. I was a co-founder of actually an internet infrastructure company. I did that for a couple of years, for about 3 years. And I was also in Japan for a couple of years, running up one of the branch offices. My education is in physics, electrical engineering from Columbia, and an MBA from the University of Chicago Booth School of Business. I'm also an adjunct professor at Chapman University. That's a university here in Southern California in Orange County. And my area of expertise is in the management science and econometrics. And I'm also chief publisher of Upside Options and a chief investment officer for QTR Capital Management, which is targeted more to institutions. So I've been in the money management side for about 18 years. Okay, just for the Pinnacle strategy, this is a non-directional options trading strategy. Just wanted to give you this is a screenshot off the website. So last year, it was a really good year, plus 36%. This year, it's a slow start. We had to navigate through the COVID crash. February 27th was the beginning of the crash, and it was one of the most violent, fastest crashes I've seen in 25 years. So I had to do a lot of adjustments, had some put spreads that went in the money. So I've been doing this a long time. I can get through it. It just creates a lot of work for me. And so I've been navigating through and adjusting trades. So in the last 3 weeks, been getting back to work, stabilizing, booked a 7.7% realized gain for May. And I'm hoping I can still kind of hit the plus 25% range for the year. That's my goal. I think I can hit it. I just, just finally through the COVID crash, and that's created a lot of work. The strategies that we offer are big cap growth, small and mid cap growth, sector rotation, that's kind of buying the strongest stocks within the strongest industry sectors. Contrarian, these are stocks that these companies have been out of favor for about a year and they're starting to come back. Iron Condor Pinnacle, that's an options trading strategy that's basically bringing in premium with our trades. The trades are typically 2 weeks in duration. Now recently, because of high volatility, these can be 1 week in duration trades. and I can bring in some pretty chunky premium, which is nice. So it's a nice market to bring in premium. It's just it does take adjustments when the market goes crazy, and last 4 days the market just went up, and we had 1,000 Dow point up day. SPX was up 80, and that's a lot of movement. So that will hit some of my trades, put them under pressure, and then I have to adjust them. So it creates more work, but I'm getting through it, and volatility is coming down. And then we have a leveraged dividend income strategy. Now this one's coming soon. And my partner, he's been doing this for about 4 years, and it's a very interesting strategy. So you'll be hearing more about that. So our differentiation, I just have a few more slides and then we'll jump into all the charts. So we do 4-level quantamental analysis where we blend technical, fundamental, and factor-based quantitative analysis. Do long short, and we have a unique methodology when we open short trades. We can keep them open for almost free. And now, unfortunately, I was not short heading into COVID. I was not getting sell signals. That was not your normal type of correction. That was just a crash from, a healthcare crisis. We were getting expensive. We were expensive, but I've learned over the years never short the market in February because it can really hit you hard because this market usually will go higher through February, March, and April. Those are the strongest years of the month, strongest months of the year. So I didn't have any shorts, and then we had the COVID crash, so I wasn't too pleased about that because when I have my short trades, and I can usually add 10% to the portfolio. And I just was not getting my normal sell signals that I watch for because I follow strict exit rules. I let the winners run, but I have very specific exit rules where I move fast enough. With these rules, we can lock in the gains to protect capital. So for example, for a normal type of correction, October 2018, we went from 75% allocated to 15% allocated in just 6 days because the market started rolling over and it was more of a normal type of correction. You can see it through certain breadth indicators and certain candlesticks. And it's hard to know how deep it's going to go and how long it's going to last. It's actually impossible to know, but all I know is that our exit rules were triggering back then. Went from 75% allocated to 15% allocated, and then for the 2018, our strategies all were positive. They're all great, excellent returns, where the benchmarks were all negative for the year. So we follow strict exit rules. All right, almost done here, and then I'll jump into the charts. So this is our 4-level scanner that we use for stock picking. So we do macro, high-level analysis, technical, breadth, fundamental, and I'll be showing a lot of those charts in this presentation. And we're really looking for overall sentiment to modulate our bullish, bearish exposure levels. And then we do a technical scan. We're looking for high probability setups, and that's for the big cap, the small and mid cap, the sector rotation, and the contrarian. And then we do fundamental screens. We want to make sure that we're getting into the best stocks for the bullish trades or the weakest companies for the bearish trades. And we don't open a lot of bearish trades on weak companies. What we'll do is we'll just do bearish hedges macro, on the SPX, for example. Trading bearish trades on individual companies, that's a world of its own. And we can do it, but it's hard to do. Then we do a quantitative screen. That's all probabilities. It's probabilistic types of analysis. And then we use technicals to give us our triggers to get in and out of stocks. We allocate about 4 to 5% of the capital to each position. So again, that's for the stock strategies: small cap, big cap, large cap. I'm sorry, small cap, big cap, the sector rotation, and the contrarian. And just one slide on quantitative analysis, because a lot of people ask, what is quantitative analysis? What does that really mean? So the use of econometric statistical mathematics to provide predictions such as probability that a stock will break up or down through a particular level, and a probability that a stock will make a particular magnitude of move up or down once it breaks up through a particular level or breaks down through a particular level. So this is multi-regression statistical analysis. It requires several years of education in econometric mathematics, statistics, with several years in developing and optimizing models. And then this is the output. and it looks like this. So we run this on about 3,500 stocks. You get all these numbers, and what it does is it gives us a final analysis and a final way to choose the stocks to get into and get out of, and it's very powerful stuff. And that's what I'm an adjunct professor in the area of statistics and analytics and econometrics. Okay, let's talk about the market. Let's start looking at charts. Let me just check, see if anyone had any questions. Okay, everything's fine. Okay, so we had the COVID crash, minus 30 to minus 40% on just about everything. That was one of the fastest, most violent crashes that I've seen in 25, 30 years. It also was not helpful that the market was at an all-time high at that time. And the market was getting expensive. We were trading at about 19.2 times forward earnings at the very end of February. All the indicators were telling me we were still grinding higher, not much higher. We were starting to run out of steam. And that would have been a normal market. You start running out of juice. We start, exiting on certain positions. We start cutting exposure a little bit. We start opening up our bearish trades as we're heading into March, April, because April is usually a very strong strong month. So you have to be very careful with that for that seasonal trend. And then COVID just boom, hit. So stocks are rebounding and some have fully recovered. So for example, the Qs, that's the NASDAQ 100, and then the NASDAQ Composite, they've retraced 101% of the crash. That means they've already fully recovered and they're taking out new highs. I'm very surprised, but the market's going to do what it's going to do. And we'll see if they can stay at new highs. I don't think they're going to, but we'll see. SPX is above a major level of 3,025, and I'll show the chart. Breadth has broadened, so more stocks are participating in this most recent uptrend. And buying stocks in March and April, they've done very well. So for the big cap in March, when everything was way down and there was a tremendous amount of uncertainty, we started piling into very high quality big cap stocks, just stocks that I believe that had very good fundamentals, that were been around for a long time and had a very low probability of going bankrupt. Those are up all 25 to 50%. So that was good, and we are now selling those stocks. I'm starting to get out of anything that starts touching highs, I'm getting out of. Anything that's breaking out to new high, I mean, if it's already above, we'll let it run a little longer, but I'm not feeling comfortable with what I see. Non-directional strategies, they're working, and I'll pull it off. My gut guess is telling me from doing this for almost 18 years is that I'll probably generate a 25% gain. That's my target for the year, but I've already lost many months. I've already lost 3 months of trying to navigate through COVID, and that's a little disappointing, but it is what it is, and I'm getting back to work. Okay, for the indexes, let's look at the index. First one I want to bring up is one of the ugliest charts I've seen. So this is a weekly chart. We go 2020 all the way back to 2012. This is the NYSE Composite. It has 1,900 stocks in it, mostly trading on the NYSE. And we can see that we were up here getting pretty choppy, sloppy. A lot of this was, Trump's China trade war. This was the correction that I talked about with our portfolios. We started getting all our sell signals up here. We went from 75% allocated down to 15% allocated and successfully timed that. But I just followed the exit rules. The exit rules are telling me get out, we're getting out, and we'll start cutting exposure. And then we ended up with a pretty nasty correction. And we took out new highs. We're up here. And then we had the COVID crash. That's about a 35% correction and crash. I'll call it a crash because it was in about 3 weeks. That was just absolutely brutal. Here's the S&P 500. This is also a weekly chart. So every little candlestick represents 1 week of trade. We go back to 2014. This is about a 30% correction. That is a lot for the S&P 500 index. Here's volatility, VIX, forward-looking anticipated volatility over the next 30 days for the S&P 500, went up to 85. Last time we saw that was during 2008, during that crash in 2008 and that recession. So we're down to about 24 in VIX. That's still very elevated, and that's why I'm kind of enjoying selling credit spreads, because I'm able to bring in very nice size premiums for just 1 week trades. So I'm going to enjoy it while it happens. But it does take work because some of these do get under pressure pretty fast and you have to adjust them. The 10-year note, we're down to 0.9%. I think it actually popped a little more today. We're probably going to get up to 1% shortly. And money's been flowing into bonds all this time, pushing the 10-year way down. This is the yield curve difference between the 2-year note and the 10-year note treasuries. And it's improving. The yield curve is improving, and that's good. That's a positive for the market, but you can't read too much into this. All I know is that the fundamentals of the broad labor market is not good. So we'll cover that. Corporate earnings, they're not good. Here are corporate earnings. This comes from FactSet. If you want this yourself, just type into Google FactSet Earnings Insight. Type in FactSet Earnings Insight, and their free earnings report comes up, and it's very robust. I look at it each week. This blue is the S&P 500 index. Black is forward 4-quarter earnings that the S&P 500 companies are going to generate over the next 4 quarters. We went from almost $80 of earnings, let's say 175, down to 145. So forward earnings cut from 175 to 145. That is, S&P 500 companies are now projecting to generate $145 of earnings over the next 4 quarters. That's what this means. That's not good. So market's trading at 22 times earnings. You take what it's currently trading at, 32.20 divided by 145 bucks, and it gives you about $22 worth of earnings. I'm sorry, 22 times forward multiple that the market's trading at. That is very expensive. Okay, so market's classified as expensive. Let's look at some macroeconomic data. So I'm not showing that much economic data because it's all a disaster. And the stock market is disconnected from the economy. I mean, sooner or later, the fundamentals do overtake the stock market and they will prevail, but the stock market always overshoots or undershoots. And right now it's overshooting with optimism. So we're at 14% unemployment, non-farm payroll change. So we lost about 22 million jobs. Now we did have a pop, just the newest payroll number was a positive surprise where we generated 2.4 million jobs, but we still have 20 million people out of work. Unemployment rate sitting around 14%. ISM manufacturing index just fell off a cliff. It's below 50, meaning that it's contracting. Production and capacity, it all fell off of a cliff. I mean, this all looks the same. Here's the ISM index for manufacturing is below 50. Here's core retail sales. This drives 70% of the US economy. It's all down, 15 to 20%. So people are still buying, but they're still buying a lot through Amazon and online. But of course, the malls got hit hard and sales were down 50 to 80% on most stores. Here's forward-looking GDP. Actually, this is for Q2, estimated Q2 GDP. And the Atlanta Fed believes that we're going to be at minus 45, minus 50%. Most analysts believe we'll be at minus 35%, and economists. Regardless, we're in a recession right now. So we'll see how fast we bounce out of it. Worldwide charts, how's the rest of the world doing? So here's Europe, and recently everything popped. So we're back over some of these support levels and back up to the 200-day line. That's what this line is here. So that's healthy, that looks good. Or at least it's a positive and it's optimistic for equities. It doesn't mean that it's really truly tracking the economies, and we're probably getting way overextended. Actually, we are getting way overextended. But it just tells me that, well, the market wants to go higher at least for another week or 2 or 3. Germany bounced, it's up here. Emerging markets, EEM is back up to over the 200-day line. China is up over the 200-day line. And this is the world, ACWX is the world X the United States. So this is everyone else, mostly large companies around the world. And that one's back up to the 200-day line. So that's a positive. Okay, let's look at our charts. So back to the NYSE, I'm showing this is the weekly chart, 1,900 stocks trading on the New York Stock Exchange, and it's just one of the ugliest charts I've seen in forever. So that is a very violent, deep 35% correction, but it's bounced. So we're back over this support level here. So that's a positive. Now we could get stuck in here for a long time. And, you know, NYSE is kind of a canary in a coal mine. It's an interesting index to watch, and it's very prescient in predicting the future. So right now it tells us that this market's probably going higher, not lower right now. But if this NYSE composite starts dropping below this support level, I'm going to start getting much more cautious. Here's another ugly chart. This is the small caps, IWM. It's an ETF that tracks the Russell 2000 index and looks similar to the NYSE composite. Just very ugly chart. Now for the small caps and the mid caps, you do expect to get a very ugly chart because they get hit hard. They get hit the hardest. This is an index you don't want to be holding for the long term usually. Whenever we have a correction, it's the first one to fall below the 50-day line, the first one to fall below the 200-day line, the first one to take out new lows and to bottom out at some past low. And this one literally came down to the 2016 lows. So that's typical for a small cap. So you have to be careful with the small and mids. Okay, here's the NYSE. Now these are daily charts now. So here's the daily chart. Every candlestick represents a daily values. And we can see that it's back up to the 200-day line, so that looks good. We can see the Dow Jones. Here's the Dow Jones. We're starting to break out above this major level. So this was kind of the all-time high recently at the end of 2019, where we then broke out, took new highs, and then we had the COVID crash. So worst possible time to have a COVID crash when you're at all these new highs. So this is pretty impressive. So to be back up here, we'll see what happens. I mean, everything's telling me it wants to go higher. It's just this market's getting very overextended. Here's the S&P 500. This is the weekly chart going back to 2014. This is just before the election. This was really ugly right here. We're taking out lower lows. We're pretty much heading into a recession. That's what the stock market was telling us. Trump got elected, the stock market took off, and then we started just going sideways and choppy, and this was kind of a mess here for a good year and a half. Took out the higher highs, 33.88, and then crashed. All right, well, now we're back up to 32.16. That's impressive. That's very impressive. And off of $145 worth of earnings, we're trading at 22 times earnings. So that's very expensive also. So if anything, I'm going to start opening puts shortly. So that's called a macro hedge. You start opening puts at the money, slightly out of the money, puts on the SPY. That's the ETF that tracks this. But then they have to be managed. I mean, it's a trade. And that's how and then we also will sell call spreads against that to pay for those hedges. Here's the daily chart, S&P 500 index. So here's 2019. This was that correction that we had. So that's when our strategies did well. We generated anywhere from plus 15 to plus 25% gains for that year for 2018 because we got out. And we're back up to 32.16. Okay, so I'll talk more about kind of where we're going next and floors and resistance and stuff like that. Okay, NASDAQ Composite. This has about 3,000 stocks in it, and this one broke out to new highs. So that is very impressive. You know, we do have, you know, the Amazons of the world. That's the problem. You got, you know, Microsoft, Amazon, Apple, and a couple of these large, you know, just 5, 6, 7 of these huge companies that will move this index because they represent 20% of the index or 15% of the index. I'd have to check. I haven't looked at the numbers recently, but that is one of the aberrations of these indexes because they're market cap weighted. So that's not fair, but that's why we have to watch breadth. We have to see, you know, we know that Apple broke out to new highs today, and I'll show the charts. Microsoft's just starting to. Amazon took out a new high today, and that is pushing this up. But you have to be careful. We have to make sure that all the other stocks are participating also. And I'll show you the breadth chart for this index. Qs, NASDAQ 100, mostly large technology stocks, broke out to new highs. I think that's because mostly of Apple and Amazon. But a lot of other tech stocks are doing fine, at least right now. IWM small caps, and we're back up over the 200. So this is good. We needed this. We need the small caps to validate the rally and to make investors feel comfortable that small caps and mid caps are also participating. Corporate bonds, these are the high yields, HYG. Look at that crash. It's telling us that investors suddenly realized, oh my gosh, a lot of these lesser quality companies could go out of business and go bankrupt. So suddenly the investors wanted much higher yields for high yield. So HYG is high yield. Then investment grade is LQD. This is all triple B and above in quality. So it's mostly large, high quality companies that borrow money. They both crashed, but they bounced back pretty fast, and we can see LQD is back up near its highs. HYG is not yet near its highs because these are lesser quality of companies. Because they're back up here, HYG and LQD, it tells me that the market is okay right now. Both bonds market, high yield bonds market, corporate bonds market, and the equities. So it tells me for the next week or 2 or 3 or 4, we're probably fine. Okay, more on the macro analysis, big picture analysis. Here's market sectors. And this tool right here is called ETF Replay. If you guys want to look at it, if you want something, it's a decent tool. It helps you analyze the sectors, etfreplay.com. And it's not that expensive, and it does a decent job. And I just mark the ones that I like. So this is rank in order of sector. So these are different sectors, and they're all ETFs. I follow about 85 sectors, and this represents the top half. And there's a model of how it ranks them, and then you can control the model. Different models and of returns over certain time frames, and then volatility. That's what it looks at, and I kind of tweak the model a little bit. So cloud computing, mid cap. What I'm looking for are secular types of industries that represent growth for the economy. And when these start climbing, it usually tells you that, okay, I mean, everyone believes and investors believe that the economy will probably start, continue to improve. So internet stocks, here's Russell midcap, cloud computing, here's the S&P 400, semiconductor stocks, that's a leading indicator, tend to be growth stocks. Software industry, here's the small caps, here's technology. So these are all in the top 30, and that's actually really good. So that tells me that money is flowing into the proper sectors, and that tells us that investors believe that the economy is going to continue to recover. Okay, let's look at the charts of some of these sectors. Here's XLI for industrials, and back over the 200-day line. That's good, just in the last couple of days. And these tend to be multinational companies, large companies like a Honeywell, for example. So we're General Electric. General Electric is a bad example, but Honeywell is probably a better example. And that's a good company also. That one looks pretty good. Tells me that we're probably okay with the broad stocks market for the next month, especially since we got a break over the 200-day line. Banks, you really want the banks to be a little healthier than they've been looking, and recently they just popped over certain levels. Here's a level down here, that's good for the banks. That's a positive for the stock market. I'll be much happier once the banks get up into here and get over the 200-day line. Consumer discretionary, we're at all-time highs. That's a positive. Those tend to be companies, consumer discretionary types of things, going out to restaurants or buying a pool table from Brunswick or buying an ATV vehicle, things you don't really need just to survive. RYT, this is a tech ETF. It's telling me if tech is leading, that is very good for the broad economy. I'm sorry, very good for the broad stock market. Not the economy. Stock market's different from from the fundamentals of the economy. They're two different animals. So technology is looking good. Transports, that's a leading indicator. You want to make sure transports are participating. They finally are, just in the last couple of days. kind of broke up into here. You wanted to, first step one is to always get over this low here. All these charts look very similar. Get back over the low. That's step one. Step two, get it over the next low. I got the line drawn here. So whenever you're looking at charts, always draw your horizontal lines. Always draw horizontal support and resistance lines. That's the first thing you do. And then always put a 200-day line on it. I also show a 13-day EMA, put a 50-day EMA on it. And you really want to get this stock or this ETF back over its 200-day line. And you want to get up in this range here. And that will tell you that you can trust this market more. SMH, semiconductors, leading indicator. Look at this, just took out a new high. And this is 2-day old, 1-day old chart. I don't know what it did today, but that's a positive for the broad economy, and it's a positive for the stock market. Breadth. These are advanced decline lines, and they tend to be pretty good leading indicators. These are cumulative advanced decline lines. So every point on here represents the number of advancers minus the number of decliners. So you get a number, and then you add it to the prior day's number. And you just keep on adding these numbers, and it's cumulative. And this is called the cumulative advanced decline line. And it's really showing you are more stocks advancing than declining for that day. And then as you add them cumulatively, it'll start either climbing upward or it starts going downward. So this is for the S&P 500 index. So it's watching the 500 stocks in the S&P 500 index. And you can see that we have been grinding higher. I put on a 20 and a 40-day moving averages on here, and it's telling me that this market wants to go higher still. NASDAQ, this is for the 1900 stocks in the NASDAQ composite. And I'm sorry, I think there's 3,000 stocks in this one. And same thing, this one I got a 17 and a 40 on it. 17's above the 40, that's good. And it's climbing, that's good. Tells me this market wants to go higher at the moment, at least for another week or two, maybe longer. Got to take this week by week. This market is getting very expensive and overextended. Okay, let's look at some stocks. First thing I usually do is I want to look at the big stocks. What are they doing? And because a lot of people just will kind of follow the big stocks. And I see Microsoft, we're at all-time highs. Now we're not really breaking out yet, but we're getting close. We'll see. It could also tell me that this entire market could fail because all these big caps, like the Apples who just broke out today, or the Facebook, or Amazon, and I think I got Amazon here. Here's Amazon. And if they can't hold at their highs and keep on grinding higher and they start failing, then that could send a signal to investors to start dumping stocks. And we'll have a 5, 7, 10% correction. And we could pretty easily. Right now, Facebook is climbing. Microsoft is kind of up, testing its highs. XLK is a technology ETF. It's testing its highs. That's good. We want technology to be participating. Apple just took out a new high. That's positive for the broad market. How much higher can it go? I don't know. It broke out, so you will see a lot of people piling into stocks and piling into Apple and trying to take advantage of the breakout. Amazon broke out. That's a positive for the market. Okay, let's look at some stocks. I'll just throw out no particular order, but these are stocks that are still on sale. You can think about, picking some of this up. Make sure you do your own analysis and make your own decisions. Jets, so that has the airlines in it. Instead of buying the individual airlines like Delta Airlines, or UAL, United Airlines, I think someone's going to go out of business. Someone's going to go bankrupt or get bought. They could reorganize where the stockholders lose all their money and then the bondholders take over. That's just a risk for the airlines. So I've been very careful with this. If you want less risk, you buy the ETF that has all the airlines in it. So that's Jets. One really good company is Love, that's Southwest. They have a very good balance sheet. And they do a lot of more local travel versus international travel. And I heard international travel might be struggling for a long time. So maybe Southwest Airlines, but you can see these are still on sale. Now, these are all the stocks that we've been picking up, but we did this a long time ago, back in March. We're kind of running out of stocks that are still on sale because everything has run so much, but these are still on sale. So airlines, here's UAL here. I am tempted. I am tempted to get into United Airlines. I think the probability of them, I think they're going to be an acquirer versus being one that reorganizes. But I don't know. I'm not an analyst. I've not done super detailed analysis on these airlines. I use a package that does more of a high level analysis and gives me ideas of what I should be in and should be out of with regards to fundamentals. It does a very good job of fundamental analysis, but I'm not an analyst full time as a day job. Dryden restaurants, that's still on sale. It's like Red Lobster and Olive Garden and things like that. So now some of these could be risky, but I'm just throwing them out. And these are stocks that I'm looking at. Boeing starting to pop. I think Boeing will be around forever. I think the government will just continue to bail them out until we're back to normal, until their 737 MAX is flying again, and until all the airlines start flying and buying airplanes again. So sooner or later, this stock is going to be back up here. Just don't know how long it's going to take. JP Morgan, banks are still on sale. Now they popped a lot in the last couple of days. JP Morgan is one of the best banks out there, but you have Bank of America, that's BAC, Citibank. I mean, they all look similar, but JP Morgan definitely is in a class of its own. More restaurants. Here's Cracker Barrel, Old Country Store, still on sale. Large company. What's the probability of them going bankrupt and closing all the Cracker Barrels up and down the highways? You can go outside the United States. India, this one looks pretty good. It's out on sale. Here's insurance brokers. They tend to just go up and down, and they're always going to be around, and they're never going anywhere. Insurance companies will always be around, and you just need to time it. Whenever you can buy some of this on sale, you buy it on sale. Brazil's looking pretty good. EWZ, Hilton, another type of, all the hotels are still on sale. And what we did at the end of, or the beginning of March, when there was extreme uncertainty, I only wanted the largest companies, the biggest companies that have been around for 50 to 100 years, that had the lowest probability of going bankrupt, that had the best balance sheets, and the number one, number two brand. So Hilton's like that, Marriott's like that. Everything else, be careful. Cruise lines. Now, I have not touched them yet, and I figured that if anyone's going to go out of business, it's going to be the cruise lines. So Carnival, Royal Caribbean, and there's a few others in there. Now, one of these, and you'd have to check, but one of them did raise enough money to hold them over for a year. And I don't know if it's the Norwegian Cruise Lines or Royal Caribbean Cruise Lines, but if you're interested in it, I would make sure you look into that. Make sure you only buy the one that raised that money, because they can hang in there for another year. And we'll see, but that one's still on sale. Chevron, this is one of the best holdings for oil. They've been slammed and it's coming back, but this is one of the largest integrated oil companies. I'll tell you that, and it's starting to break up through this level here, so that's interesting. Starbucks. Now, I usually watch this along with all the other companies, the big companies. You watch Apple, you watch Microsoft, you watch Intuitive Surgical, the robotics, surgical company. You watch, see, Microsoft, Facebook, Starbucks. These are all, big companies that are, Amazon. They're bellwethers. You just kind of monitor and see what they're doing. We can see Starbucks is back over its 200-day line. That is a good thing, and that just will kind of help out the broad market. Okay, let me just check one thing here. Okay. Next, Home Depot. Actually, that's another bellwether. I watched that one also, along with Amazon, Facebook, and Apple. Watch Home Depot. Now, this one's breaking out and taking out new highs. We already sold it. When stocks started touching their all-time highs, we already got out, booked our 25, 35, 40% profit. And I just don't I'm having a hard time understanding or a hard time wanting to be in stock that are taking out all-time highs when we have a 13, 14% unemployment rate. So I think that some of these could fail. And if they start failing, watch out below because this market's going lower or it's going to correct about 5 to 10%. Now, one stock, MasterCard and Visa, these are always good to own. And if you can get them on sale, yeah, pick it up because they're not going away. They've been around forever and they're going to grow for another decade or two. So MasterCard still could be picked up. I'm showing a trend line. It'll probably get up to this point or even match this high here one of these days. So that's MasterCard or Visa. Both charts look very similar. Cisco is one of the large, this is not Cisco Systems, this is SYY. This is the food distribution company. It's pretty much the largest out there. Everywhere you look, you see these Cisco trucks and they're delivering food to the restaurants. That one's still on sale. And well, if you could have, now we already had this. We bought this one way down here. So it's already up quite nicely. And I think it's just going to keep on going higher. I mean, this one probably could, I really don't want to get out until it starts getting back up closer to its past highs, because I know it's the #1 player out there. Insurance. This was similar to the ETF I showed you, is the KIE. You could just buy the KIE, or you can get into specific insurance companies like Allstate, ALL, or the Hartford. These are all large companies, high quality companies, and these are still on sale. Now you have to be patient on all of these. You just don't know how long it's going to be. Could be weeks, it could be months, it could be 6 months, but you'll probably double your money because they're big companies and they're high quality companies. Okay, so let's go back to the questions to address. So the Qs, the NASDAQ composite, they all broke out to new all-time highs. So how is this influencing the rest of the market? Well, it's influencing it a lot. Whenever you see the Qs are breaking out, you see the NASDAQ composite breaking out, you will see, the algorithms pushing more money into stocks. You'll see individuals plus, hedge funds pushing more money into stocks. And, the stock market it always overshoots or undershoots. Right now it's overshooting and it's probably going to overshoot even higher before it starts running out of juice. So the SPX broke up through 3,025. What is the next target? Let's bring up the SPX again. That is the weekly chart. I wanted the daily chart. Okay, let's just look at the weekly chart. So on the weekly chart, we're going up to 33.88 now, and that's up here. How quickly will we get there? Well, I don't think we're going to go straight up there. I think we're going to end up having a pullback first, and then we'll probably get up to 33.88, and then we'll probably hit resistance there. And now if we're trading at 33.88, I mean, if I type that into a calculator, that's probably 24 times earnings. That is just off the charts expensive. And so we need companies' earnings to catch up to where the market is. So we can get back up to $175 worth of earnings. Now we're back to 19 and a half times earnings. But right now we're at $145 worth of earnings. And we won't know now for many months about what earnings are going to be for the next quarter. All right. And by the way, the 3,025 line is here. That's 3,025. That was the main high until we had the most recent breakout. That started in mid-November, and then it trended strongly. It just went straight up, and then we crashed. So that's pretty ugly. It gets no worse than that, where you're overextending and the market's overshooting and getting pretty expensive. We were at 19.2 times earnings. That was based off of $175 worth of earnings, and then we crashed. So it just gets no uglier than that. It just gets no worse than that. All right, if the market sells off again, how low can we go? Let me go back to the SPX. Here it is here. All right, here's the S&P SPX daily. So here's 3,025. That was this high here. That was right at the 200-day line, broke up through. That's where we're at now. And that was the break that we had in mid-November. Okay. So now since we're up here and we start correcting, The first potential level of support is 3,025 right at the 200-day line, and that most likely will find support unless something really changes. Like all of a sudden we have some major hotspots, coronavirus really starts shutting down states again. And if we do, then we're probably coming right back down to 28.22, right down here. So we'll probably be back below the 200-day line down to 28.20. We'll probably find support right here somewhere. And now for a non-directional strategy, I like that because we'll get stuck somewhere in this range, and then that's what I do. I trade the ranges hard. I'll be selling calls up here and selling puts down here, and I can do that for forever. Like last year, the market was stuck between two ranges, and I was just bringing in 5-6% a month, continuously by selling calls and selling puts in ranges. Right now, I have to be very careful with this gap up here because this market's going higher probably. But I think it's going to go up. It's going to pull back somewhere and then go up and touch. So it's probably going to take many weeks. All right, so what would be the best investment strategies for the balance of 2020? Well, we're already selling some of these stocks. The ones that, at least the ones we got in March, those were all up 35, 40%, some are up 50%. We're getting out. I'm booking profits on those. I am going and staying long on stocks that have not yet touched their highs. They're still grinding higher, and a lot of the charts look that way, where they're just near the 200-day line. And so market's path of least resistance right now is up, so I'll still stay long. And these are high quality companies. These are all fast growing companies. They have excellent earnings growth. I'm not worried about these companies going bankrupt. So we just kind of hold them long. And passive buying index ETFs, yikes. I would be pretty careful on any of the passive ETFs right now. I would only buy something that's just breaking over its 200-day line. Here, let's look back at some of these. I just showed a few, like XLI, industrials. We'll probably get back up here over the next 2, 3, 4 months. But boy, if we have a second wave with coronavirus, then these companies are very international. Like a Honeywell, they sell all around the world, and they have lots of different businesses. I'm more of a stock picker, I think, in this market versus just broad ETFs. Banks, you could buy KRE or KBE for the banks because sooner or later they're going to be back up to their highs, but it could take 6 months to a year for the banks. So that's a decent one. You don't have to stock pick, other than I would just pick up JP Morgan, Bank of America, maybe some Citibank, and then KRE, which is the regional banks, and then just hold them. Just hold it until you double your money. Consumer discretionary, I would not touch. Tech, I just wouldn't touch. Definitely not a broad ETF. I would not touch semiconductors. Everything's overextended. So I would be more of a stock picker and then selling calls and puts. That's what I would be doing. So I'd be selling some of my passive ETFs. If they've touched their highs, I would. That's what we're doing. And if the stocks are taking out new highs or touching their highs, we're selling. Should I add short exposure to my portfolio? Yeah, you could. You could buy some slightly out of the money SPY puts in the next week or two, but you have to be prepared for them to draw down because that is a trade. And this market does want to grind higher, and it probably will grind higher first before we have a correction. But that short trade, that's a trade, and you have to watch it. And then you have to figure out when to sell it, because that's not an easy timing type of decision to make. Okay, so that is the extent of the next step. Is I can talk about Pinnacle, and if you guys want to stick around and learn more about what I do with selling calls and puts, then stick around. I'm done with doing the macro analysis of big picture of the economy, big picture what the stocks are doing, what the ETFs are doing, and what we're doing. And So before I move on to Pinnacle, let me know, do you guys have any questions? Send me some questions if you have any of what you saw with the charts and with regards to the questions that I was answering. Okay, it's quiet, so no questions. All right, so this is being recorded, so you can listen to it again if you want. It'll be up on the Upside Options website, upsideoptions.net website. So if you want to see it, it'll be recorded. Okay, so Pinnacle. Pinnacle is we do credit spreads, sell call spreads, sell put spreads, and then when you put the two together, it's an iron condor. I do it on the SPX index, and I've been doing this for about 18 years, and it's always been my go-to strategy. I just always liked it. It's always been nice to generate income, and but it takes a lot of experience, and you have to know how to adjust trades, and you have to feel comfortable in adjusting trades. So kind of moving and swaying with the market. We can predict what the market does about 75% of the time, and then 25% of the time you're wrong with your prediction. And that's just part of any trading strategy. You're not going to be right all the time. So we're going to be wrong about 25, 26, 27% of the time, and something will get under pressure or go in the money rapidly, and you need to make adjustments. And that's the part that takes a lot of experience. And so I've been doing it a long time and feel very comfortable in moving trades, and I kind of call it, kind of do tap dancing around the market. So I make a move, the market makes a move. I make a move, the market makes a move. But the market is the boss. I have to follow what the market does, and I have to react accordingly. And usually you want to stay ahead of the game, so if the market starts moving, I have to kind of predict out about a week and say, oh my gosh, all right, I think we're going higher. I better move these now versus later. Excuse me. And then I can move them pretty cheaply. So 75% of the time, I'm not moving much. And then 25% of the time I'm moving trades. So Pinnacle's on a conservative, non-directional, income generating all weather strategy. It's optimized and adapted to the new political era. So now I had to do this about 2-3 years ago when Trump took office. It took me about a year to wrap my arms around how to handle him and his tweets, because that's all new. We've never had anyone tweeting and moving the market so much, and tweeting right when the market's open, right in the middle of the day, and then battling it out with China, and that was whipsawing the market all over the place. So it really created difficulties for traders, especially non-directional traders. So what I finally did is I decided I had to be more nimble, I had to move more, had to sway and with the market more, and I needed to cut my exposure way down. So now I allocate about 30%, sometimes 40% of the cash. I got plenty of cash to maneuver and make adjustments. So I can handle Trump now, but it took a good year for me to wrap my arms around it. So I can generate positive monthly returns in upward trending, downward trending, or sideways and choppy markets. And so, for example, when Trump was doing all the craziness and with the China trade war, you could really bring in some nice premium when the market's just going nowhere. It's going sideways and choppy, and it did that for 18 months. That's actually perfect for this type of strategy. So really, this strategy just augments other strategies. You just kind of put it in your toolbox, and you use it continuously in parallel with everything else. And you're like, okay, I got long stocks, that's great. You might do some hedging, that's good. I got my non-directional strategy that generates premium every month, that's good. And so it's just a strategy you just kind of strap on to your other strategies. So we hold a maximum of 3 to 4 positions at any one time. That represents 30 to 40% exposure of the cash in the portfolio. Each position represents 10% of exposure. And also what I did back 4 years ago, and then especially when Trump came on board, is I needed to cut my exposure from 20% per trade down to 10% per trade. So I made it more granular. And that was another thing that I did. And then I knocked it down to 2-week in duration trades using weeklies, because I was doing 4-week and 3-week duration trades, but I went down to 2-week, faster moving, more nimble, more trading. And I like it. I've been doing it now, this approach for about 5 years, and I like it. It's working well. So we hold enough of cash in the accounts to make the trade adjustments when volatility unexpectedly rises, and with Trump in office, that can happen at any time. So it is what it is. I just have to adapt. That's my job as a trader. That's all traders have to do. You just adapt to whatever it is. Don't complain, just adapt. So the strategy is conservative by construction because I'm doing more of just keeping things at 30%. And but it still generates some nice solid monthly gains. The target's usually about 3 to 5% per month. I try not to go any higher than that. I don't want to push it. So, because I can push this thing to 10% per month. I can push it to 15% per month, but there's no free lunch. There is no free lunch. So you start pushing it, it creates a lot more work, then it starts creating more risk. Once you start hitting up, up against certain levels, like trying to generate 10% per month, too much risk. So it's just not worth it. Capital preservation and safety are a top priority, and have got about 18 years of experience in trading this strategy. Okay, so let's just build a trade. So this is on the SPX, and I am selling a 3010 call, and I'm buying a 3020 call. Now this trade was built in 2019. All right, and then I sell a 2855 put, and I buy a 2845 put. So nothing is naked. These are all protected. So it's a spread, meaning I sell a put here. So I'm on the hook for this put that I sold, 2855 put, and then I buy a 2845 put as protection. And that creates a bull put spread, a put spread. But I bring in a premium because of the one I'm selling is closer to the underlying. The underlying is kind of right in between here. Here's the underlying. So this is the SPX, and at this time, this blue line here represents where it closed at just when I was building this trade, and it closed at 29.51. All right, so 29.51 is where the underlying is, and I'm selling the 3010 above it. I'm selling the 28.55 below it, and then I'm buying these for protection. Bought the 3020 call and buying a 28.45 put. You create the credit spreads on both the top and the bottom, and this is an iron condor. And then you bring in a credit, and then the credit can be viewed on the risk reward graph. Here's profit down here. Here is the $0 line where there's zero profit. This risk reward graph is not the classic view. Classic view, usually this is on its side. This view, actually, you flip it, and I've always liked this view more, but most stock platforms and like Thinkorswim and all the other ones, I mean, they show it more of the classic view versus this view. So this one's flipped up on its side. So anything to the right is profit for the trade. Here's $200, $400, $600 of profit. Anything to the left of this vertical line is a loss for the trade. And this iron condor has a bear call spread on top, and it has a bull put spread on the bottom. All right, so let's build it. So we sold the 3010 call, and these are usually, I open up two-week trades, and recently I'm opening up 5-day trades because volatility is high. So I'm opening up 5 trading day trades. I can bring in similar premium to something like this type of trade. But these are usually 2-week trades. So I sell a 3010 call. So here's the strike here, 3010. And there, that points right there represents the 3010 call that I sold. Here's the 3020 call that I bought. And let's just look at the top right now. So now it tells me that if this underlying, here's the underlying, it's trading. If it starts climbing, this blue line is going to start climbing up here because this represents where the stock is closing for the day, each day. And as long as this blue line or the closing value of the stock stays below this short call that I wrote, I can keep this premium that I collected when I first opened a trade. And here's the premium, about $400 worth of premium. So I'm risking, it cost me $1,000 to open up this trade for a quantity one. $1,000. To open up the 3,010, 3,020, that's a 10 wide spread. The broker's going to hold $1,000 to allow me to open this trade, and I'm bringing in $400 worth of premium. Now, actually, this had an error, and I'm truly not bringing up this much premium, and I wouldn't bring that much premium in anyway. I'd bring in more like $300 of premium or $280 of premium. So just pretend that this line is over here a little bit. But right now, it's just showing that I'm bringing in $400 of premium, and I need the underlying, the SPX index, to stay below this short call and above this short put. And this short put is the 28.55 put that I sold. And what we're doing is that on a daily basis, we're selling calls and we're selling puts. So if the market's up, these speculators get all excited and they're like, this market's going higher, I want to buy calls. So you open up your storefront, you're saying, okay, I'm selling calls, who wants to buy calls? And you sell calls. There it is right there. We sold that call and a speculator bought that call from us. And then 2 days later, the market's down. And then the bears get all excited. Hey, I think this market's going lower. I want to buy puts on the SPY or the SPX. And then we open our storefront and say, selling puts, buy puts here, and then we'll sell that put right there. So we bring in the premium, we're bringing in $400 into our account, actually more like 300. But it's only $1,000 that's being held. And this trade might only be for 2 weeks, even less than 2 weeks. And you're bringing in like a 30% gain over 2 weeks. But that's why you don't want to allocate more than 30% of the entire portfolio, because I want 70% cash in that portfolio, because I'm bringing in 30% gain on some of these trades, or 25% gain in 2 weeks. So I sold that call, and then I buy this call for protection. I buy this call for protection, and then as long as the underlying stays right in here, this is expiration. This line represents expiration, telling me that if this underlying index stays in this range through expiration, this will be my profit, and I will keep it after a week or two, $400. And then if not, if this line starts climbing and going up and hitting my short call, that's not good. And now that takes work. Now I got to move that call up. I got to push this thing up, and many times I'll take this put spread and push it up also. And so that's called an adjustment. And then these lines here represent what the trade is worth as a function of time. When you're 14 days to expiration, you use this red line. When you're 10 days to expiration, you use the blue line. 5 days to expiration, we use this line. And then at 0 days expiration, the day of expiration, we use this line. Okay, that's the iron condor, and that's what the trade looks like. I guess I should have showed this because this is larger on your screen, but it's pretty much the same chart. Okay, so we have the underlying index trading here. This is a function of time. This is the SPX. The blue line represents the closing value for that day when we opened up the trade. You usually want to, sell the call. And right now, the calls I have like 120 points, sometimes 150 points between my short call and my short put. So I can get very wide ranges, but I have wide ranges because the volatility is still high. The SPX volatility VIX is still in the 25 range. So this market can move a lot from day to day. Okay, and then just looking at what types of trades that would be opening today, here's the SPX. This is the weekly chart. Let me go to a daily chart. All right, here's the SPX daily chart. And right now I'm writing 3280 calls and 3060 puts. So I'm writing pretty close to the 3025, and I'm fine. I don't need to be below it. I mean, it would be nice to be below it, but there's no free lunch and there's not a lot of premium down there. I can bring in a chunkier premium if I'm above 3025. And if the market suddenly starts correcting and coming down and hitting my put spread, then I'll just move it and I'll push it down. And I know that I'm already close to 3025, so I can just push it down once or twice and I'll be down here right at the 200-day line, and that's most likely where the SPX will find support and bounce. And then I'm getting up here close to the 3,300 for my short call. And this one's a tougher one because this market so far has just gone straight up. Now, can it go straight all the way up to 33.88 just in the next week or two? Well, it could. I hope it doesn't, and I hope it doesn't go that fast all the way up. It shouldn't. It's very overextended already. It should start sputtering a little bit, pull back, and my trades are only open for a week. But if they start getting hit, then I have to just keep on pushing them up, and I'll have to push them up 100 points if that thing just keeps on going. But that's the world of writing spreads. And they're only open for a week, and they're bringing in some nice chunky premium. So these trades are about 30% gain per week right now since VIX is high. Okay, so I think that is it for, oh, I just had one more. Here, let's just, for the trade that I built, okay, here it is again. So these happen to be October from last year, SPX October 29.55.45 put spread. So I wrote the 29, I sold the 29.55, I bought the 29.45, sold the 29.55, bought the 29.45 put spread, and it's called a bull put spread because you want the market to be bullish. You want the market to stay above where you're at. I want the underlying, this index to stay above this short put of 29.55. Plus, I have the October, same date, same expiration. I sold the 3010 call. I bought the 3020 call. That's called a 3010, 3020 bear call spread. Bear because I want the index to stay below where I'm at. Add the two together, and it's iron condor. Here's the premium for this particular trade. I brought in a $1.30 credit for the put spread, brought in a $1.70 credit for the call spread. That brought in $300, and 300 divided by, and actually, if you want the true ROI, it's higher. Instead of dividing it by 1,000, you divide it by 700 because you truly brought in $300 into your account. So now your maximum risk is $700. It's not 1,000, it's 700. So 300 divided by 700 is a 43% return in about 2 weeks. And that's about a 3% gain for a $10,000 portfolio. And then right now I'm doing 2 to 3 of those open every 2 weeks. And you kind of spread it out, and I'm just trying to make that 4, 3, 4, 5, 6. I mean, right now I'm bringing in higher. The last month was 7.7% realized, and you can bring in, I just don't really want to go much higher than that. So 10% is allocated to each of the trades. And yeah, this one, what I was showing here is we had higher volatility when I built this trade. So that allowed me to bring in like a 43% return trade in 2 weeks. Usually I'll try to, well, I mean, recently I have still been bringing in $3, meaning $300 into the account for $1,000 that's being allocated. Okay, so just kind of summarizing for Pinnacle, this was last year, up 36.8%. This year, I'm hoping I can still kind of hit that plus 25% or greater. I have lost several months due to the COVID crash. That's been no fun, trying to navigate through that. And also that was challenging at the beginning of the year, November, December, January, when the market's just moving too far in one direction, that creates a lot of work. It's constantly going up and hitting my calls and hitting my calls. And the market broke up through in November and late November, early December, and that's pretty typical. The market will normally do that in November, December, and especially January, February, March, April. Those are always the strongest months. So I am aware that the market's going to do that or can do that, but I'm still trying to trade through it. And so that move, it was challenging, and I got through it. I started making some money, and then all of a sudden we had the COVID crash. So we're through that. I'm getting back to work. I still have a few trades I'm adjusting out of, and hopefully I can hit my normal positive return that I'm looking for the year. Okay, so consider trying Pinnacle for free. You can go to the website, upsideoptions.net. It's recommended to auto trade this strategy. It's a pretty fast moving strategy these days. 10 years ago, 8 years ago, 15 years ago, you can do it yourself. It was much slower moving. not anymore. It's a very fast-moving strategy, so I would recommend auto trading. And if you want to learn it yourself, you just kind of open up your own account in parallel, and then call me, talk to me, email me, and I can teach you, and you get pretty good at it in about a year. And you just do it in your own account. But let me auto trade one part of it, a chunk of it, and then you take a small amount and you do it yourself, and then you can just learn in parallel. So for auto trading, we open and close all trades. No action is required by you, and all of our strategies you can auto trade: large cap, mid cap, small cap, sector rotation, contrarian. And at least for Pinnacle, we make all the adjustments, and things can get very fast moving. So here are the strategies again that we have. And then this one's coming, leverage dividend income strategy. And this it's very exciting. It's a pretty complex, but it's an elegant strategy. It's a very elegant strategy, and it's fully hedged. So that is very exciting because people are getting tired of their accounts just whipsawing all over the place, and we just experienced it again. So this one takes advantage of a handful of very large, well-capitalized, high-quality companies, like an AT&T, for example, that pays a high dividend, and then we fully hedge it. That can handle a 30% crash, for example, and then we leverage it. And so it allows us to bring in some nice returns with this strategy. Okay, that's all I got for you. If you have any questions, I'm looking at the question pane right now. And then if not, I'm already way over. It's 11 minutes after 3 o'clock. Okay, I don't see any questions, and I am running over, and I can see people are already dropping off since we're late. So, okay, well, thank you very much for your time. And if you want more information, go to upsideoptions.net, and you can get free trials of our strategies. And then if you want to learn more about iron condors, credit spreads, and you want to learn it, just reach out to me, and I always talk with clients quite a bit on the phone. And if you want to learn it, I'll be willing to help you learn it, and you'll get pretty good after about a year, but it does take a lot of experience to know how to really adjust the trades. And that takes many years, but as long as you're working closely with someone that has a lot of experience, you won't get into too much problems and trouble with credit spreads and iron condors. Okay, well, thank you very much for your time, and I will talk to you next time. Well, thank you. Bye-bye.